Welcome to the next event in our China Capital Market series. I'm Virginia Birrell, the CEO of ACBC Victoria, the Australia-China Business Council, and it's my pleasure to greet you today. I'd like to begin by acknowledging the traditional owners of the land on which we meet today, the Wurundjeri people of the Kulin Nation in Melbourne, and pay my respects to their elders past, present and emerging. I extend this acknowledgement to the lands from which all our guests are attending from around Australia today, and also offer a very warm welcome to our guests zooming in from China. We're pleased and thankful to our partners, the China Construction Bank Sydney branch and the Office of Monetary and Financial Institutions Forum for today's online seminar. And we warmly welcome all guests from these organisations joining us online. We're delighted to have our friends from AustCham China and AustCham Shanghai networks, together with members from ACBC branches all around Australia. We thank you, each of you, for your interest in this important event. This is the second in a series of 5 webinars being organised by the Australia-China Business Council that explores the evolution of China's currency and the implications for investment into China capital markets. Before we begin, I'd like to flag that we have a late apology from Mr. Mao from the People's Bank of China. We apologise for this unforeseen change. Replacing Mr. Mao will be Mr. Shen Huayu from the China Construction Bank's head office. Today's seminar will run in 2 parts. Firstly, we will have keynote presentations, which I will introduce as we go. I would like to remind you that an updated attendee information pack has been sent out to you, and it contains detailed speaker information. In case you missed it, we'll be posting an access link in the chat box at the bottom of your screen. Secondly, we will have an interactive panel session moderated by Stephen Wolfe of Macquarie. I invite you to submit questions you may have using the Q&A box at the bottom of the screen. We'll try to get through as many questions as possible in the time available. And if time runs out, we will take these questions on notice and get back to you after the event. I will shortly hand over to the National President of the Australia-China Business Council, Mr. David Olsson. He is a former managing partner of global law firm King & Wood Mallesons, and has recently taken up a role as international director for that firm with a focus on the Greater Bay Area. He has been working with clients in Asia for more than 25 years, including 5 years based in Beijing. He has a particular focus on financial markets and cross-border trade and investment flows, and was a key driver in the formation of our China Capital Markets Working Group. I now have pleasure in welcoming David to the screen for some preliminary remarks. Thank you.
Thank you, Virginia, and allow me to add my welcome to everyone to this webinar. As Virginia's just mentioned, the ACBC, CCB Sydney branch and OMFIF share a common interest of increasing collective knowledge within the Australian financial markets community about China's capital markets and the regulatory environment in China. With that objective in mind, we have put together a series of 5 webinars on topics of interest to Australian funds managers, asset managers and asset owners, as well as for those that are just keen to build their knowledge of China's markets. The first webinar was held last December and provided an introduction to the China fixed income bond market. Today's event, the second, is focused on the internationalisation of the renminbi in the context particularly of capital flows into China. We know that for many Australian investors, they already have an exposure to China's domestic capital markets, but for most of them, it's an indirect exposure via participation in global indices. As China's markets continue to grow and evolve, we anticipate that investors will inevitably need to reconsider direct investment into the China market by either allocating to specialist China market funds or establishing direct channels via QFI, RQFI and custodian arrangements. In today's session, we've got some truly outstanding speakers who will outline a pathway from indirect to direct investments. So I'm certainly looking forward to today's session, as I'm sure you are. So on that note, I'll hand back to Virginia to introduce our speakers. Thank you.
Thanks, David. It's always a pleasure to have you joining us for these events. And thank you for your terrific support. I would now like to introduce Mr. Jin Yangtong, the General Manager of the China Construction Bank Sydney branch. Mr. Jin has over 30 years of banking experience, joining CCB Sydney in early 2015. Under his leadership, CCB has built a strong reputation across the country and has become one of the most popular choice of syndication banks for the Australian market in recent years. Thank you, Mr. Jin.
Thank you, Virginia. Thank you, David. Distinguished guests, ladies and gentlemen. Welcome to CCB and OMFIF China Capital Market Series. This is our second webinar on RMB investment opportunity in China. I would like to take this opportunity to acknowledge the support from the ACBC and our event partners, the OMFIF. Thank you for making this event happen. We hope all our friends here today can have a better understanding of the benefits of the China capital market through today's webinar. China Construction Bank is the first bank that commenced custodian service in China since 1998. CCB has been ranking #1 in terms of the QFII, RQFII among the Chinese peers over the past 5 years, and is ranking #1 in terms of the newly approved QFII, RQFII in 2020. CCB has built a deep relationship with the major global custodians, including JP Morgan, State Street, and BNY Mellon. As one of the largest financial service providers globally, China Construction Bank has an international operation network. We recently launched the CCB Match Plus platform, which is another statement to the market that CCB can facilitate global trade and investment by connecting business partners together. Here in Australia, China Construction Bank is officially celebrating its 10th anniversary in local market last year. We now have the 4 branches in Sydney, Melbourne, Brisbane, and Perth. 10 years ago, when we first set our foot in Australia, we made a promise to provide best-in-class service to local clients and community. Fortunately, now we can proudly say that CCB has kept its promise. So lastly, thank you everyone again for joining today's event, and I do hope you will find this webinar insightful. Thank you.
Thank you, Mr. Jin. I'm now delighted to introduce you to our first keynote speaker, Shen Huayu. Mr. Shen is the head of Overseas Non-Bank Institutions Division, International Business Department of CCB Head Office. He joined CCB in 2000 with 20 years of extensive working experience in international business, including international settlement, trade finance, foreign exchange, policies management, and financial institutions. Mr. Shen obtained his MBA degree from Tsinghua University. Thank you for joining us today from China, Mr. Shen. We look forward to hearing your insights.
Thank you, moderator. Good afternoon, everyone. It's my great pleasure to give you such brief introduction of China's financial markets and the relative policies you may concern about. And we are very glad that more superior foreign investors, just like you, have shown deep interest in China's financial market. Thank you. In today's presentation, I will follow these 4 sections, which including the market overview, progress of RMB internationalization, overview and the details of opening up of China's financial market, and finally, the outlook. Yeah. According to National Bureau of Statistics of China, China's GDP in the first quarter 2021 grew up 80.3% year-on-year with an average 2-year growth of 5% at comparable prices. Moreover, according to IMF, the estimated GDP growth, the growth rate of China in 2021 is above 8%. Chinese financial markets stand out with relatively high and stable earnings. And from the figure, we can see that the yield of China's 10-year government bonds stand above 3%, over 100 basis points higher than that of the United States. At the same time, the yield of Germany's government bonds is nearly 0, and the yield of Germany's government bonds is negative. So China has become the 2nd largest bond market and the stock market in the world. By the end of 2020, the outstanding volume in China's bond market has exceeded 100 trillion yuan, equivalently to about $70 trillion US. The stock market has seen 48% growth, and it has outperformed other major markets in 2020. This is especially significant in the context of the global pandemic. In the bottom, in spite of China's large market size, foreign investment only accounts for 3.4% of bond markets, which equivalent to 3.5 trillion yuan, and 5% of stock markets reached over 3.3 trillion yuan. Compared with other major markets, they have 10% to 42% of investment comes from foreign investors. China still has huge room for growth. So the progress of RMB internationalization with the continuous improvement of China's opening up, China's economy has been fully integrated into the world economic system, and RMB has gradually gone globally. The RMB internationalization has been further developed as RMB is increasingly used in cross-border payments and financial worldwide, and played as a positive role in the international monetary system. The RMB payments function have constantly strengthened. Investment function have continued to increase. Reserve function have gradually emerged, and the pricing function have achieved a breakthrough in February 2021. The share of RMB in global trade finance was 1.3%, only next to the US dollar, euro, Japanese yen. According to IMF, the scale of RMB reserve has reached 245 billion US dollar, ranking 5th as a reserve currency globally. And the market share of RMB in the foreign exchange trading was 4.3%, which was among the top 8 in the world ranking. The share of RMB in global payments was 3.49%, by the end of March, ranking 5th globally. So opening up of China's financial markets has forged steadily. Here we can see some of the recent key progresses. Starting from July 2019, the Chinese government released 11 measures. It set up the roadmap for further opening up and pushed ahead multiple key opening time. In 2020, the opening up has not slowed down in spite of the pandemic, but accelerated instead. In January, allowing foreign investors to hedge their FX risk with more tools. In April, China removed the limits of foreign ownership of securities and fund management companies. In May, China removed the restriction on QFII, RQFII investment quota, simplified investment profit repatriation procedures. In September, released 2 exposure drafts for further opening up in China's bond market, and officially released a key QFII regulation, lowering the requirements for market access and allowing wider investment scope. All these changes have streamlined application procedures and removed the restrictions to provide more enabling conditions for foreign investors. China has formed a multi-tunnel and a multi-level opening pattern, covering the stock markets, bond markets, derivative markets, and foreign exchange markets. For offshore market access, we have Stock Connect and Bond Connect. Shanghai Hong Kong Stock Connect, Shenzhen Hong Kong Stock Connect allows international investors to trade securities in A stock markets through the trading and clearing facility of Hong Kong Exchange. By the end of 2020, the market volume held by foreign investors through this channel accounted for 35% of total RMB financial assets held by foreign investors. Bond Connect allows foreign investors to trade in each other's bond markets through a market infrastructure linkage in Hong Kong. For onshore market access, we have CIBM Direct and QFII. Through CIBM Direct, investors can have access all kinds of bond products, including cash bond, repo, bond lending, bond forwards, interest rate swap, and forward rate arrangement. Regarding the QFII, the previous separate regimes for qualifications and rules are integrated. So in recent years, the regulators made efforts to optimize and improve these existing opening tunnels, facilitating international investors to use RMB to invest China's financial markets. Regulations allows funds to be transferred between the accounts under the CIBM Direct and the QFII with the same account holder. Remove the quota restriction of QFII and RQFII, and also removed the area limitation of RQFII. Moreover, regulators took measures to unify qualifications and extend available in investment scope of QFII. Regarding foreign exchange risk management, foreign investors in CIBM conduct exchange derivatives trades directly with financial institutions or enter China's interbank foreign exchange markets. In the future, the regulator will continue to improve relevant regime and policies, infrastructure arrangements, and supporting facilities, further opening China's financial markets and provides a more friendly and convenient investment environment for international investors. Hopefully, interconnection between CIBM and the exchange bond markets will be launched. Over the past few years, international communities recognition of China's financial markets increased significantly. China A stock was included to FTSE Global Equity Index, as well as into MSCI Index and SP Emerging BMI. Chinese bonds was included into Bloomberg Barclay Global Composite Index and into GPI Emerging Government Bond Index by JP Morgan, and will be included into WGBI by FTSE in October this year. The RMB internationalization is natural market-driven process. In the future, we believe China's regulator will explore ways to promote a higher level of pilot program to facilitate trade and investments. Besides, the opening up of China's financial markets and the interconnection of infrastructures will be continuously promoted to keep abreast with international standards to further facilitate foreign investors to use RMB to invest in China's bond market, stock, and other financial products. Also, CCB, as one of the largest commercial banks in China, are also working on 3 new products to solve the settlement failure and the liquidity problems, which would be useful supplements for current policies. First is contractual settlement. Under CIBM, settlement should be done on T+0 and T+1 basis. Sometimes the settlement will fail due to the long payment chain of the overseas commercial bank and the custodian. Contractual settlements will provide both intraday and overnight overdraft. Bond pledge is required for some investors and no extra obligation required. Second is financing through RMB bond pledge. Under CIBM Direct, repo is not open for commercial foreign investors. Based on the pledge of RMB bonds held by foreign investors, our overseas branches or subsidiary will provide loans. Third is RMB bond portfolio in local currency. CCB International will issue notes with Chinese bonds as the underlying assets to meet the need of foreign investors to invest in local currencies. We have had several talks with regulators about these 3 products, and hopefully CCB will be able to provide these services as soon as possible. China's financial markets are thriving with new opportunities, and we sincerely hope that you can be a part of this exciting progress. As a major player in China's financial markets, CCB is confident to provide you with professional investment services, and we welcome you with our open arm to China. That's all for my today. Thank you for listening. Thank you.
Thank you, Mr. Shen, and thank you again for stepping in at short notice to give that excellent presentation. We're most appreciative. Up next from China Construction Bank Financial Markets Department, we have Ms. Liu Jing, Deputy Chief Manager of Fixed Income Trading. Ms. Liu has more than 10 years experience in domestic and offshore financial markets, including fixed income, precious metals, and FX. She's also previously been dispatched to CCB New York branch's Treasury Department. Ms. Liu is currently in charge of CCB's RMB credit bond market business and will share details of this with us today. Thank you, Ms. Liu.
Thank you, Virginia, and good evening, everyone. This is Jin Liu from China Construction Bank Head Office, Financial Market Department, and I'm the team manager of our bank's Chinese bond market making business team. And today my topic is opportunities of Chinese interbank bond market investment, and I will also shortly introduce the Bond Connect scheme. So firstly, I will go very quickly about the market review and outlook. You could see that in 2020, the yield curve was quite clearly divided into two parts. The first one is the first 4 months. The bond yield decreased because of the pandemic, and Chinese monetary policy was very loose to help to support the Chinese economy. However, after May, the bond yield increased because the pandemic situation has improved, and also because the Chinese monetary policy was back to normal. So let's see this year, in the first 4 months of 2021, bond yields have seen some volatility, but are still little changed from the beginning of this year. Now the yield to maturity of 1 year, 5 year, 10-year Treasury bonds are 2.31%, 2.91%, and 3.12% respectively. So here is our market outlook this year. You could see there are two factors supporting declining bond yields. Number one, monetary policy still aim to ensure reasonable and adequate liquidity in the money market. Number two, China's bond market has become attractive with higher yields compared to other countries' rate of return. However, there are three factors driving rising of bond yield. Number one, inflation pressure. Inflation pressure caused by rising commodity prices will remain for a while. Number two, incoming supply pressure in the second and third quarters. And number three, global economy is recovering. So our viewpoint is that the yield rate is expected to remain in a narrow range, and the 10-year central government bond yield will be within 3% to 3.3% this quarter and next quarter. Now let's see part two, more opening up of CIBM, more opportunities for domestic and global investors. During the past 20 years, Chinese governors have been working actively to help the opening up of Chinese financial market, especially the bond market. In 2017, Bond Connect scheme was launched. Actually, for foreign investors who want to enter the Chinese interbank bond market, there are two channels, CIBM Direct and Bond Connect. So here is a table that I just compared the two different channels. Under CIBM Direct Invest, all foreign investors need an agent, but under Bond Connect, you don't need an agent. And under CIBM Direct Investment, all the trade should be done through agent via CFS. Under Bond Connect, all trades you could do is just directly trade with the market maker of Bond Connect, and all your trade was done via TradeWeb or Bloomberg. And under both CIBM Direct and Bond Connect, foreign investors could do FX hedging, interest rate hedging, and some special investors could trade repos under CIBM Direct, but none of the investors could trade repos under Bond Connect. And here are 5 very important numbers for foreign investors. Number one, 1,130. The total number of investors have increased to 1,130. 3%. The trading volume of overseas investors is only 3% of CIBM's trading volume. 3.5%. 3.5% of CIBM outstanding belongs to the overseas investors. 83%. Interest rate bonds are 83% of overseas investors' portfolio. And the last number, 563. The amount of overseas investors holding is $563 billion US. So we could see that the absolute number of foreign investors entering the Chinese bond market is relatively small, but however, the growth rate is dramatically. We could see the two charts in this slide. Under Bond Connect, the trading volume of Bond Connect investors is increasing each month. Actually, last month, the total trading volume is 520 billion RMB. And in the right chart, the numbers of Bond Connect registered investors is increasing dramatically each year. Recently, the number for investors and its products is 2,505. Actually, out of the top 100 global asset managers, 76 has enrolled in the Bond Connect scheme for their Chinese bond investors. I think that's mainly because of Chinese bond is included in the global 3 most important global bond index. However, besides of the asset managers following the index, there are still Chinese bond yield is still very attractive for foreign investors. You could see that the yield of the 10-year Chinese central government bond was 3.06%, and the yield of the 10-year US Treasury bond was 1.56%, which is 115 basis points lower than the yield of 10-year Chinese central government bond. And in the right table, you could see the bond yield of the some very important countries. We could see that in some European countries, the Treasury bond return is still below 0. So finally, I want to talk about some CCB's roles as one of the Bond Connect market maker. CCB is one of the top market makers in CIBM. Each day, we offer the bid-ask price for more than 200 bonds and covering all kinds of bonds, such as Treasury bonds, policy bank bonds, commercial papers, and we have traded with more than 2,000 counterparties. We also have traded with plenty foreign investors, such as foreign central banks, sovereign funds, asset management companies. We are one of the 15 Bond Connect market makers, and we are very active in the market. In the right column, I just list some of the awards we won during the past several years. You could see that in 2019 and 2020, CCB won the award of the Best Bond Connect Market Maker and the contributions to opening up of CIBM by Bond Connect Company and by CFS respectively. CCB is not only very active as a market maker, we also have lots of advantages in the Chinese financial market. We have full license in CIBM, and we are one of the top underwriter. And our bond invest portfolio of RMB bonds ranks top 3 in Chinese commercial banks. We are top FX market makers and one of the best interest rate derivatives market maker. So for foreign investors who want to open the Bond Connect business, CCB could help you under the full process. Number 1, we could assist in filling with PBC. And number 2, we could help you open the account. Number 3, we could trade with you and our traders could give you the calls each day. And finally, consulting service. We could provide latest market news and investment suggestions. So that's my brief introduction about the CIBM and our bank's Bond Connect business. And finally, what I want to say is that CCB is one of the 4 biggest commercial banks in China. So today we are here to give you this presentation. It's not only that we want to do business with you, but it's our responsibility to help foreign investors to understand much better about Chinese bond market and help you understand and entering the Chinese bond market. I just list my email address and my Bloomberg code here. So if you have any questions, just feel free to contact with me. Thank you.
Thank you, Ms. Liu, for that very comprehensive presentation. Next, I'm delighted to introduce you from CCB's Head Office Custody Department, Mr. Shenglong, who will guide us through the CCB custody service for Chinese bonds. As a specialist cross-border custody business with more than 10 years experience of servicing QF2 and RQF2 clients, Mr. Li and his team focus on providing comprehensive solutions for overseas investors in the China market, including license application, policy consulting, custody and investor services. Over to you, Mr. Li. Thank you.
Thank you. Evening, everyone. And I'm Shenglong from CCB Head Office, Custody and Investor Service Department. And I'm very happy to be here to share my points. And my team is looking at all the channels coming to China. So today I will introduce you a lot about the investment channels and our custody service. Okay, let's start from here. Okay. I believe my colleague just shared a lot about China bond market. So I'd like to talk more about the opportunities and the channels about equities and other markets open to overseas investors. So here, we have the channels here to come into China for CIBM bond. We have Bond Connect, we have CIBM Direct, and for A-share and other market, we have Stock Connect and the QV and RQV. So among all of the channels here, I believe the very hot topic will be QV and RQV, because since November of last year, no rules of QV has become a very hot topic by integrating QV and RQV, lowering application threshold, simplifying the approval process and expanding the investment scope. QV has been much more useful and flexible than ever, and it has attracted a lot of investors from overseas. So under the new policy, you do not really need a financial license or some good numbers in your AUM. So just some investment experience will be sufficient for you to apply license. And the application has been much more simplified, and you only have to wait a few weeks to get approval. So we can see a lot of PE fund or prop trading firms showing great interest in this area because they do not hold financial license offshore and they cannot access this market before. Okay, more importantly, QV and RQV new policy expand the investment scope widely to repos, to SBL trade, to private fund, to community futures, a lot of. So what the QV and RQV investors can invest is just like some investors in China market. So that is a very big step for the regulator. And in this new investment scope and instrument, and we can see a lot of quant fund managers and hedging fund managers to come into China by QV RQV because new investment instrument brings more opportunities for their profits. So here I showed some newly opened and the most popular ones. They are SBL, they are IPO private placement, they are private fund and the community futures. And in recent years, most of my clients told me that that QV is not so convenient, it is not so flexible, so they turn into the Stock Connect. Okay, that's the true story, but it's all history now. This is because the new policy of QV RQV last year have removed all types of quota. So you can remember that there's no more quota for any countries and regions, no more quota for license holder, and no quota for even every account and products. So in addition, the currency limited and the repatriation limited is also removed. So which means that with the QV license, you can set up your account with the local custodian and invest as much as you can. And the most important is that QV is almost a tax-free channel because most tax has been removed by regulators. So we can see that now QV has become your best choice if you want to build a very comprehensive channels and to have access to different assets in China, especially the A-share market and the IPO private placement. And you can cooperate with local fund managers via QF investment. So it's overall channels, and you can do a lot of things. So it's a very good time for you to apply QF license here. So as I just mentioned, CCB custody as a custodian, we can provide you a lot of convenience and in your investment in China capital market. And there are some reasons. The first one is that we are state-owned bank. So we always keep a very great and healthy relationship with the Chinese local regulator. And we can provide accurate explanation of such regulations and market practice for you to make all of your investment compliance. And secondly, we provide cross-border custody business directly from our head office. A dedicated manager in charge of overall relationship and your detailed procedure of your fund setup. So as for CCB's custody business, it has started from the 1998. So it has been 20 years, and we are growing together with our country's asset management industry. So especially the recent 6 years, our asset under custody has grown more than 3 times, and it has reached 2.5 trillion USD by the end of last year. And currently, we are serving more than 3,000 clients. We have 3 operation centers, and yes, we have more than 300 employees here. And by the end of last year, we are ranking the #1 position in terms of QF and QF AUC among Chinese peers over 5 years, and we are ranking #1 in terms of newly approved QF QF in the market in 2020 last year. So in the market, there are about 7 newly approved QF QFs, and CCB takes more than 25. So it means that in the new time, it is the new policy, CCB has leading the position in the market in both the peers of foreign custodians of Chinese custodians. So CCB also, just as our my colleague just said, we also build a very strong and deep custody relationship with the major global custodians. There are 19 in all, and in which 10 has been it's been in the top 10 global custodians, 9 have appointed CCB as their local market, and we are also the clearing member and the settlement member of all the Chinese infrastructures, like the exchanges, like the central depositories, and so on. So we are really doing a very great job here. And if you are interested in China capital market, we will be happy to accompany with you and be your best partner for all of your US investment journey. And okay, that's all my presentation. Thank you.
Thank you, Mr. Lee. Now to provide us with an Australian asset manager and asset owner perspective of investing into China capital markets, I'm delighted to introduce Mr. Mark Burgess. Mark has an extensive global career leading asset managers and owners. He's a senior advisor to the industry and holds several non-executive positions, including with OMFIF, as well as sitting as chairman of OMFIF Asia. Mark is an independent chair of Yarra Capital Management, chair of the advisory board of Jamison Coote Bonds, and non-executive director of the Northern Territory Infrastructure Development Fund. He has an extensive history in the industry, previously managing director of the Future Fund, Australia's $120+ billion sovereign wealth fund, CEO of Treasury Group, and more. Thank you, Mark, for joining us today. I'll now hand over to you.
Thanks very much for the introduction, and thanks for all the previous speakers that have helped set the foundation of the discussion about the Chinese capital markets, particularly as it relates to foreign investors into the market. I do chair OMFIF, as you mentioned, and just to explain what OMFIF is, it's a think tank based in London, but we have offices in Singapore and Washington, and we're particularly focused on monetary policy, the role of central banks, the role of financial markets, digital monetary policy, and also sustainable investing, amongst other things. But as part of OMFIF's work, we work very closely with asset owners around the world. We have them at round tables, but we also work very closely with central banks and policymakers. As Virginia mentioned, I'm also very actively involved in institutional investors here in Australia. I just wanted to touch on the way I perceive people approaching the Chinese market at the moment and some of the broad issues. As everyone on this call would be aware, there are two sort of broad characteristics of global financial markets which are causing pressure for institutional investors and retail investors around the world. One is the lack of global yield, but also the second issue, which is perhaps not widely discussed, is the search for diversifying assets. Diversification, as you know, for any investment portfolio is absolutely crucial. And as we've seen interest rates fall close to zero around the world, in fact, below zero in some places, it's lifted all assets, and it's creating a situation where, while we're enjoying the rally, we know that it's creating a concentrated risk or a potential risk that assets will all act as one. And I mentioned diversification because China, in its current stage of development and its current stage of economic cycle, is responding differently. And for such a major part of the global financial system, this has been noticed by investors more broadly. So the first point that I think is attracting people to China, or at least considering increasing exposure to China and taking a medium-term view, is the very clear story that China has moved differently from a policy perspective and a cyclical perspective during this COVID period. And particularly, I think, has learnt the lessons from the global financial crisis in the more, let's call it, cautionary approach, or what I'd call medium-term strategic approach to the way the economy is being managed. The net result of that is that the economy actually recovered sharply, but it also means that monetary policy, for example, is operating on a different basis to other countries around the world. That's creating an attractive yield spread towards China. But also China's being cautious in the way that it's approaching fiscal during this recovery, which could, and this is where investors, I think, are attracted to China, could create a smoother environment as the rest of the world deals with very large fiscal stimulus, then taking fiscal stimulus away, and the volatility that causes. So China is clearly marching to a different beat. I'd also say that China is developing a real maturity in its approach to capital markets. And of course, as everyone on this call would be aware, it's looking, for example, in a very careful way, but looking at how domestic Chinese may invest offshore, so it's a cautionary approach, but is also recognizing the importance of foreign flows into China. And there's now been a systematic policy, for example, of allowing the attraction of ownership of financial institutions within China. It's really foreign investors setting up within China, but also allowing better access to the Chinese market. So you've got a macroeconomic story, but you've got the secondary story, which is a policy environment which is very different today than it was, say, a decade ago in a positive way. So for foreign investors, particularly here in Australia, this has obviously been noticed, but around the world. And the most important thing is that there's now, as we've seen from a number of presentations, far easier access to the Chinese market and a far more systematic process to access that makes that attractive. Interestingly, surveys of large institutions around the world shows that they weren't aware of this improving access to China really only a couple of years ago. That has improved dramatically in the last 2 years, but it's taken a long time for them to recognize, I think, that the Chinese capital markets have been changing. One of the most powerful ways that this is coming across, though, is that we are seeing, as mentioned by one of the other speakers, an increased weighting in indices. And as much as not all of us want to be a passive investor, by increasing a weight in index, it does obviously attract passive investors who invest in the index, but it really gets a wake-up call for active investors who tend to benchmark themselves against similar indices. And so that market share weight has been a powerful influence. And I think the Chinese regulators and the Chinese policymakers have been aware of the importance of that development. So people are aware of it, the access is better, the indices are making the obvious share better. It's not all absolutely clean sailing. It is in a number of areas, perhaps equities, government bonds, but also China, because of its policy, and I think, again, this is a sound policy, is also working with where risk should be shared within the financial system, and particularly as it relates to some corporate debt areas. So it's not 100% clean sailing for investors as China looks to pass some risk back to investors who have invested perhaps unwisely in some areas of the market. But overall, I think foreign investors understand that. This is not untypical of what occurs in any market. And so it's not a reason to be unwelcome to China, but it certainly is a change at the margins of the Chinese system, which in the long run is actually very healthy, I think, for financial assets. The third area that I think is making the market attractive is, and it might be very obvious to state this, but it's simple, that China is going to be a big part of the world markets. It is, even though it's rising its share in indices, it is underrepresented in indices still for its absolute market cap. And while indices take a look at a variety of factors in determining the percentage that they put of a country into the index, for example, the liquidity, it is unambiguous that China is an important player and will continue to be a very important player for all investors who are looking to get global diversification. The other feature of China, of course, is that its own dynamics. I talked about the cyclical dynamics before, but many of the other very important thematic dynamics, such as the continuing growth of the middle class in China, the continuing move towards a more domestic-oriented economy with domestic consumption. These are themes and ideas, together with the technology that China is at the leading edge of in many areas. These are ideas and exposures that foreign investors can get access to, and that simply cannot be ignored because of China's attractiveness in that regard. So how are investors actually investing in China? Well, I'd say that it's still developing. There are a number of very large, sophisticated investors who now actively allocate to China as a country, as opposed to, say, an index like Emerging Markets Index, which China is a big share of. But those investors tend to be large investors above, let's say, $25 or $30 billion. They're able to put the resources into direct investing. And some of the very largest, like CPPIB in Canada, have very stated large allocation plans to invest into China because they're putting the resources behind investigating the market. But others are still allocating to emerging markets indices. They are now allocating to global bond indices, which do pick up Chinese weight. But largely the China exposure is coming through emerging markets indices. But I think that's going to change. And the reason it's going to change is that here in Australia, we're seeing the consolidation of large funds. And so we're beginning to get more mega funds similar, say, to the Future Fund of, let's say, 100 billion or 150, 200 billion. And as they mature in the next number of years, they will almost certainly allocate more to direct investing in countries like China. They'll allocate more to the resources of internal teams to follow the markets, to make the decisions for investing. And, you know, I think it very wisely, any one of those large funds will be thinking about, for example, making sure that they're registered, that they're able to operate in the Bond Connect. And that's a clear underlying trend. To give you a simple example, I heard a CIO speak very briefly last week. And one of his entire top 4 themes was the theme of diversification that China will bring. And that's the kind of discussion and analysis that is certainly picking up speed. Asset managers here in Australia have done the first leg. They're allowing, for example, Chinese exposure in their products. And you can see this when you read the registration products. The registration of the products, they have to declare what countries they're able to invest in. Many are not yet directly investing in China, but again, I think this is a trend that is absolutely inevitable, particularly as the Chinese market grows. So overall, it's very clear the trend is towards investing in China, being prepared for it. And even if we see ups and downs of the cycle, it's almost inevitable, in my opinion at least, that this will be a forward-looking approach that they will continue to increase their share. Are there any risks that people identify? There are risks, of course. The risk of governance is always a risk that's being questioned. Other risks, for example, might be liquidity in some of the markets, but the areas that most investors are focused on, such as government bonds, are very, very liquid. And I think one of the internal risks is that large asset owners have to continue to build skills to follow the Chinese market carefully and work in partnership with other financial institutions. So in conclusion, I would describe the focus on China to have changed significantly in the last 2 or 3 years, particularly through the Connect programs, particularly through the easier access, for example, through QFI, and as has been outlined by the CCB colleagues here today. And it's, I think, inevitable that investors will continue to increase their exposure. The yield attractiveness and the counter-cyclical attractiveness and the current sense of a better diversification possibility of investing in China are key underlying planks. I'll just finally mention one thing about OMFIF, if I could, which is slightly off this topic, but I think is also relevant to investors. One of the other reasons that all investors follow China closely is clearly it is moving further ahead in some areas. And one of those areas right now is digital monetary policy, and particularly the development of digital currency potentially, and just the whole role of digital. At OMFIF, we've developed a digital monetary institute to look specifically at this. And if there's any interest, we've just held a very large roundtable with a whole variety of speakers, including the PBOC, but also the IMF, the major central banks around the world, to discuss the role of the monetary environment. And the monetary environment should not be thought about in just crypto. And I know the younger audience probably does think crypto, but the other part of it that we must all focus on is the payment system and how the payment system and banking generally will change under a new potential monetary digital environment. So there's many reasons why we should follow and potentially invest in China, but China is leading the edge of thinking about the digital currency. So I just make that comment. Feel free to go on the OMFIF website to look at some of that work that is available if you're at all interested. So I'll now hand back to Virginia, but bottom line, people I think have to think about China. Exposure is going up and it is a long run investment. And I think people are aware that China is going to continue to be and will grow to be an even more significant component of the global financial market. Thanks very much.
Oh, thank you, Mark, for that powerful information. Wonderful. Now we cross over to China for a CCB Capital perspective of investing in China. And I'm pleased to introduce Mr. Zhao Yang. Mr. Yang is Chief Investment Officer of CCB Capital with more than 18 years investment experience. He currently oversees a team of 20 investment analysts as in charge of investment strategies of the company's fund of fund products. Prior to joining CCB Capital, Mr. Zhao worked for CCB Asset Management, China Asset Management, and numerous other leading financial institutions in the Chinese market. Thank you, Mr. Zhao, for joining us today.
Thank you, Virginia. Here's my time, and I will give a presentation about China capital market and CCB Capital. So first part is who we are. Actually, CCB Capital is a subsidiary of CCB and is a joint venture of CCB Principal Asset Management Company and CCB International. So we have a registered capital of RMB 1.35 billion, and the total AUM is around 567 billion yuan. So actually, you can see from the chart, CCB ranked #1 in the industry, and you can see some other banks' name like China Merchant Bank, ABC, ICBC, and Bank of Communications. So we are proud of this position. And for the total AUM of 500 billion yuan, actually 71% of is fixed income direct investment. Also, we have a fund of fund investments of around 55 billion yuan, which accounts for 12% of the total part. Also, we have the non-standard debt obligations and the private equity projects. Also, we have the asset-backed securities. Talking about the team and the employees, actually 44% of total employees come from overseas. They have overseas work or study experience. what we do. Here is a chart of how China capital market and the economy grows over the past 5 years or 10 years. So first of all, you can see from the upper right chart, actually the total number of listed company reached over 4,000 for the last 10 years. And also the total AUM is around 80 trillion RMB. So that's a pretty big part for everyone. And with the growth of China economy, China capital markets grows as well. For example, the mutual fund, including the equity fund, bond fund, grows quite fast. Actually, the total number reached over 4,000. And you can see the participation of this and proportion of foreign investors. Actually, we have foreign investors coming more and more from overseas markets, and the total market value counts for like 2.5 trillion yuan, which accounts for almost 4% of the total market value. But it's obviously it has a big room to improve. And talking about ESG in China capital markets, actually we have ESG mutual fund, ESG ETF, ESG bond, and ESG strategy in China market. As of April 2021, the number of ESG concept mutual fund in China has reached actually 150, and the management's scale was close to 170 billion yuan. And also we have 4 ETFs tracking the ESG concept. And we have a ESG bond of AUM over 1.2 trillion yuan. And more than 60% of ESG bond rated AAA, AAA. So actually in the past 3 to 5 years, the ESG benchmark increased more than other index in China, and more and other ESG concepts in other countries. And you can see the 4th product type and features. Actually, we have fixed income plus 4th, multi-strategy 4th, equity 4th, quant strategy 4th, and other types. So we stress on the long-term investment performance, and also we consider the low max drawdowns. And we provide tailor-made products for high net worth individual investors and institutional investors. Talking about investment frame, first of all, we would talk with our clients and have a risk appetite evaluation. We would fully understand the risk tolerance, the investment cycle, and other factors of our investors. And we have 5 major categories fitting to each investor. And going forward, we would have a strategic asset allocation. It is a cross-class multi-strategy investment, and we focus on middle and long-term asset allocation. Also, we have the sub-fund selection. We would conduct quantitative and qualitative analysis, and we focus on product maximum drawdowns. And based on that, we would have a tactical asset allocation. We would conduct a rough fundamental research, which would judge on government policy and market liquidity. So here's the 4th investment strategy and philosophy. We would stress on strategic and tactical asset allocation. We would stress on sub-fund selection. We would stress on portfolio optimization. And you can see from this chart that we have 5 different categories for individual investors or institutional investors. We have aggressive, advanced, balanced, moderate, or conservative category, which fits for different investors. And you can see different mix of fixed income, equity, CTE, options, these different strategies and asset classes. Also, we would have a very good and comprehensive sub-fund selection. We would measure the maximum drawbacks and the long-term performance over the past 3 to 5 years, and we would figure out the best fit for our clients. And you can see from this chart that we would create a risk-return frontier which best fits for our clients. Actually, you can see that sub-funds outperformed others in the long term. And you can see from this chart that our simulated portfolio NAV, we have a annualized return of 37%, and we have a big Sharpe ratio. And based on our investment strategy, we would have multi-dimension analysis, and we would judge the expectations and make the expectation differences from the market consensus. And at last, we would decide how much equity level or fixed income level fits for our different clients. Here is the structure that you can find. It may be a little bit complicated, but it happens every day in CCB Capital. We would have a discussion on the government policy. We would have a discussion on fundamentals, on the valuation, and we would make a judgment based on the daily discussion. And you can see portfolio optimization based on the strategy monitoring, investment proportion monitoring, portfolio reconciliation, and risk management. Okay, we would have a full range of products for different clients. We would our clients include pension funds, banks, insurance companies, high net worth individuals, and we would have fixed income strategy, mixed strategy, equity, and quant. Here you can see a full range of different strategies and different asset classes, which includes stocks, options, CTs, IPO, the CPPI strategy. And you can see from this chart that our long-term investment performance and its drawbacks. And here's a mixed strategy. It's a multi-strategy for performance. And this is a partial equity for performance. And you can see it outpaced the benchmark for constantly. And thank you for your time. Keep in touch. Thank you, Virginia. Thank you all.
Thank you very much for your presentation, Mr. Zhao. That's most appreciated. We're now reaching the second part of today's session, and broadening out the discussion, we will take a look at the opportunities and challenges of investing in China. I invite back Ms. Liu Jing and Mr. Zhao Yang from CCB, and I'm pleased to introduce our moderator, Mr. Stephen Wolfe. Stephen heads up Macquarie Group's commodities and global markets operations in the China market, using his extensive China experience and wide knowledge of both physical and derivative markets. Stephen is now based in Shanghai and was appointed country head for Macquarie Group in May 2017. Also joining our panel is Mr. KC Low. KC is a senior consultant at Frontier, Australia's leading independent assets consultancy, where he provides analytical support to clients, asset allocation advice, and investment research. I will now pass over to you, Stephen, to lead the panel discussion.
Thank you, Virginia, and good afternoon, everybody. Let's just maybe dive in with the first question. And my first question goes to young Zhao. Could you share with the audience what opportunities do you see from the opening of China's financial market bringing to foreign investors?
Thank you, Stephen. It's a good question. I have 3 points to answer it. First is about the economy and its growth and its trend. We all know that China's economy was the only one who experienced the positive growth in the last year. and it continued to rebound in this year and going forward. If you are a serious institutional investor who puts the asset across the globe, you cannot just neglect the China economy and its capital market. It's not diversified at the international level if you miss this opportunity. Moreover, China is opening up the door wider and wider. We have QFII, RQFII, and its quota is not limited right now. Also, we have Shanghai, Hong Kong, Shenzhen, Hong Kong Stock Connect. Most financial licenses can be applied by foreign investors like banks, security houses, even financial instruments like payment, custodian, rating firms. Second, China stress on double circulation, talking about the economy. Right now, importation and exportation accounts for 30% of total GDP, while the domestic circulation remains a larger part. You need to go to the local market to participate in the double circulation, because most of the market players are listed in the local market. That's why a lot of big names in the Wall Street are moving forward into the local market, like Goldman Sachs, Morgan Stanley, BlackRock. Actually, BlackRock just partnered with CCB Wealth Management Company to have a joint venture, and BlackRock has a controlling shareholder position. Last but not least, talking about specific assets, we know that it's said that RMB would appreciate in the middle and the long term because of the strong economy and the adoption of RMB by more countries in the world. Currency is a good one. Also, China has some sectors and supply chains which tops the world, like new energy vehicles, ultra high voltage grid, complete infrastructural facilities. If these sectors or technology can go abroad and applied in other countries, these are big opportunities that you would not like to miss in the first place. And I believe it will happen definitely. Thank you.
Thank you, Mr. Young. Just moving to you, Casey, there's with the opening up of the different avenues for investment, there's a lot of access to a range of different asset classes. I'm just interested to hear from you, which asset class is attracting the most interest from Australian investors at the moment?
Thanks for that question, Stephen. So what we're seeing across a lot of the institutional investors in Australia is that equity has always been something that investors have been interested in the last 4 or 5 years, particularly since China A-shares was added to the MSCI EM index back in about 2018. Interest in equities has increased even more. And then we look at alternatives in terms of real assets like property, infrastructure, private equity. There's always been some interest there, but given the complexity and so the natural opaqueness of that asset class, there's not as much interest as you would get in other asset classes there. But I think what's really gained a lot of interest right now is in the fixed interest space. So going back to what Mark said earlier in terms of the 2 big issues facing global investors right now, which is low yield and diversification, what we're seeing is that Asian or Chinese government bonds and credit does sort of fill that role in terms of it is offering higher yield than most other developed market bonds, which a lot of our presenters have already spoke about. But also it does provide diversification in terms of low correlation to other bond markets and also negative correlation to equity markets. So what we're seeing right now is a lot of investors in Australia are looking quite attentively into Chinese bonds and Asian credit.
Thank you, Casey. I might pose the next question to you, Liu Jing. We've obviously heard a lot about how attractive the Chinese bond market is. If you could just pick one thing, what do you think remains the greatest challenge for foreign investors to invest in this market? Yeah, Liu, you're on mute, yeah.
Yeah, good. I think it's a commonly discussed question, and I would like to share my opinion here. I think liquidity is still the biggest concern for foreign investors. We know that on the run bonds, liquidity is quite good. The bid-ask spread for the most active 10-year policy bank bonds is only 0.25 basis points, and any trade within 100 million RMB could not significantly change the market price. However, the off-the-run bonds liquidity is very limited, but I don't think it's a market problem because Chinese commercial banks are the biggest holders of the Chinese treasury bonds, and they would like to hold them to maturity. So when these bonds are off the main tenor, there is no supply in the market. Secondly, the most active market investors would like to buy the on-the-run treasury bonds, so there's no demand in the market. That is why the off-the-run bonds liquidity is very limited. However, Chinese governors and market infrastructures and market makers have been working actively to improve the market liquidity. But I should say that Roma wasn't built within one day. So we still need some time. And I think the market liquidity will be much greater in the near future. Thank you.
Thanks, Liu Jing. Maybe another question back to you, KC. What are the key issues that you see that Australian investors should be considering if they're looking to invest in the Chinese markets?
So we've met with quite a lot of Chinese investment managers over the years, and we've engaged with a lot of the Australian asset owners as well. And I think what we find is the key issues is really finding institutional quality investment managers in China, which it has improved a lot over recent years from what we can tell from the meetings we've had, but we still think there is a bit of a gap between the Western standard for investment management compared to what exists in China, just because, well, it's still quite a young and growing financial sector there. So I'm talking about, having very structured investment processes, having risk controls in place, and thinking about portfolio management in terms of portfolio turnover. We hear about daily league performance tables in China, which is quite extraordinary for Western investors to think about when asset owners are more about longer term performance, not daily performance. And stuff like portfolio turnover, it's not uncommon to hear equity managers in China where their annual portfolio turnover of 300, 400%, while in Western countries, fund managers would maybe at most have 100% portfolio turnover on an annual basis. So there's a bit of difference in terms of the standards there between Western and Chinese fund managers at this point in time. But I'd say the quality has been improving. Maybe the other key issue for investors to be aware of, or at least keep in mind, is just around ESG, so environmental, social, and governance issues. So this has been a growing area in Australia and in developed markets. In Australia, particularly because regulators do now require asset owners like superannuation funds to have that as one of the risks that they monitor. So ESG is a very big factor for asset owners here in Australia, but I would say it's still quite a growing area for asset managers in China. So that's something else to be aware of.
Thanks, KC. I've got the next question for you, Liu Jing. There's been a little bit of publicity around some recent credit defaults in the market, and even these have been for issuers that have ostensibly had a high domestic credit rating. In addition to that, there's been some ongoing uncertainty around some issuances and some performance, specifically around Huarong. So I was just wondering if you have any views on how ready foreign investors are to actually participate in the domestic credit market, and what sort of improvements do you think we need to help drive that sort of flow into that sector?
Yeah, and talk about Huarong first. I also noticed recently news about Huarong's reconstruction. Actually, Huarong's situation was totally a shock, not only for foreign investors, but also for domestic investors. And we think it needs very prudent to solve the problem, because Huarong is very big, actually too big. So it really has a very significant impact for the Chinese financial market. And back to your question about Chinese credit bond market. We know that several years ago, there was no credit default event in Chinese credit bond market, which we called rigid payment. And during the past several years, there were more some of the credit default events, but I think it's very healthy for the Chinese credit bond market because it makes the investors focus more on the entities itself, but not only just look at the bonds yield. And it also makes companies be more prudent and disclose its information more transparently, and it also requires credit rating companies be more prudent in their information and investigation. And for foreign investors, I think the best ways for foreign investors to enter Chinese bond market is firstly to try to invest in the interest rate bonds. And after they acquire some knowledge about Chinese bond market, they could try higher credit rating credit bonds, especially these ones with global ratings. And finally, some of them could try the lower credit rating credit bonds. Thank you.
Thanks, Liu Jing. Casey, just want to maybe give us a couple of it really quickly, because we are sort of being a little bit sort of stressed for time. Can you just give us a short list of the sort of the risks and the near-term risks that investors should be looking out for when investing in this market?
Sure. So I think the broad risk is around geopolitics. So geopolitical tension's been increasing, not just China with the US, but more broadly with Western democratic countries. So I think that risk is likely to persist given, these are deeply rooted differences in terms of political, social, cultural, ideological differences. So those risks are likely to persist. So it's important, I think, for investors in the near term to think about how that would impact investments. The other one I'll probably just quickly highlight, which is what Liu Jing was just talking about, is around how there's been defaults in the corporate sector. The government is trying to remove that implicit guarantee for support for these state-owned enterprises, these state-owned corporates. So we could see a re-rating of credit risk in China. So that's something to be mindful of.
Thanks, Casey. I guess just while we have a little bit of time, and I do note that there's been some further questions that have come from the audience that it doesn't look like we're going to have time to get to the panel to address directly. We do have those questions noted down, and we will come back to you, or the guys from CCB will be looking to come back to you with answers to those questions. So my final question before I just do a quick whip around the panel is, obviously, for some investors who want to maybe go from having an overseas to indirect exposure to the Chinese market through indices, and as a stepping stone towards a direct investment, there's always the opportunity for a fund of funds type investment. So I just wanted to call on young Zhao just very quickly, is how do you see that tool working in the marketplace, and do you think it's a viable option for players looking to sort of put their toe in the water in China?
Okay, thank you. First of all, we all know that asset allocation that determines the main part of the performance, like more than 90%. Here's a question. At present, the political and economic environment is complicated than before. Different asset classes rotate quickly from year to year, or even from quarter to quarter. It's impossible to pick up one asset class and just wait for excellent performance. So fourth is the best and most efficient way to have the necessary diversification and exposure of different asset classes. Second, with the rapid development of China's capital markets, there are more and more public and private assets managers, like tens of thousands of managers, not to mention products. The qualifications or abilities of managers are uneven due to the variety of product strategies and the difference in investment performance. It's difficult for investors to pick up one single investment tool or manager. So for overseas customers, you need to consider not only the returns, but also the risk, say market risk, sector, company, or how to hedge the risk. Therefore, a custom for investment or product is suitable. It can make investments through a diversified portfolio. Mature fund managers can leverage domestic advantages, such as knowledge of the past performance of local asset managers and familiar with local regulatory policies to avoid some or reduce the risks and challenges. So I think FOF is the best way for foreign investors to enter the China capital market. Thank you.
Thank you, Zhao. Unfortunately, as is pretty common for these sort of sessions, time has been the enemy here today. But I would just like to ask the audience to join me in thanking all the panelists. I think there was a lot of insight shown there, and I would encourage you, if there are unanswered questions that people have, that they do send them through either on the chat or through by email, and I'm sure there will be we'll find some willingness to address those. I'll hand back to you, Virginia. Thank you.
Many thanks, Stephen, and our expert panelists from Australia and China. This certainly could have gone on for a lot longer. It's been very interesting. Before I invite Mark Burgess back to the screen to provide closing remarks, on behalf of the Australia-China Business Council, I would like to thank our partners, the China Construction Bank Sydney, the Official Monetary and Financial Institutions Forum, our supporters AustCham China and AustCham Shanghai, and all our expert speakers and panelists, and of course you, our audience, for joining us online for this important event. As proven today, the opportunities out there are enormous, and ACBC, as a vibrant membership organisation with our long-standing, broad and deep networks, sits as a critical conduit for information exchange on cross-border business and investment. We will be sending out today's recording of the presentations in a follow-up email, and in due course we'll send you all details of our next event in this series. And now for the closing remarks, it's my pleasure to pass over to Mark Burgess. Thank you.
Thanks very much, Virginia. So you've done the thank yous, and I'd just like to thank all the participants for joining. We had a very large group today, which shows the interest in the capital markets. We're doing a series. Hopefully they're interesting topics, but I'd like to thank everybody, CCB, my colleagues at OMFIF, but also particularly the Australian-China Business Council. Very important that we continue to build a very strong interaction in the financial community as it relates to capital markets within China. So thanks for joining us today, and look forward to seeing you next time. Bye-bye.